Okay, here we are, Saturday, Mother's Day. Happy Mother's Day to all the mothers out there. We've got Facebook on live. I got the webinar on. And what we're going to go over today is basically how to be the most productive life insurance rep you can be inside the house. Depending on if you're selling mortgage protection, final expense, which I'm going to finish out. Protection, final expense, and annuities. These are really our three options here is how we make our money. 1, 2, 3. So which one are you involved in most? Are you doing mortgage protection yet? Are you in final expense? Are you looking to sell annuities? Have you sold an annuity yet? Do you want to sell annuities? If the answer is yes, then that's what we're going to review today. For the new people on, and I got to give it a few minutes so everybody can log in, so I'm going to start out slow. But for those of you on here so far, I want to show you a couple things. These are some sheets that I have. Another rep gave me these actually in the organization that he uses, and he sells a lot of mortgage protection. So these sheets here are pretty cool. This one has a picture of a house on it. So then you can explain, what they can actually see a visual of a little house and what they're actually protecting, when it comes to this mortgage protection. And then you can write a lot of things on here. You can write the cost. You can write the actual equity that they're trying to protect in the home. You can do a lot there. You have the timeline and the cost. You got the time and the cost. So the timeline is like how long they have to pay this thing, or the equity that's built up in it. The cost, how it comes down over the years. And then you can give options too when you're selling this stuff, guys. You got 6 months, 12 months, and 24 months. See, this is the truth about mortgage protection here. Let me fix this here. This is the real truth about mortgage protection, is that you're not, 9 times out of 10, you're never in the house trying to pay off the home. You're doing 6 months, 12 months, and 24-month deals for them. What does that do, though? Does anybody understand what that actually does? And for those of you that don't understand this, all that's doing is buying them time to pay what bills need paid, pay the mortgage off in the absence of the loved one that is no longer with them, due to the fact that they lose that individual's income. And that buys them enough time to sell the house for the equity in it. Remember that word, equity. It is so important to your future as a mortgage protection specialist. The equity in the home is what you want them to get back, because if they don't get it, the banks will. And that's the bottom line. I wanted to show you, before this thing really gets started and all these people start getting on, those of you who are on here right now, this is how much paper I used inside the homes when I was showing people illustrations. So it's hard to see on there, but this is just paper after paper. It's just like, I even have the client themselves saying, do you always go through so much paper when you're, illustrating things? And these are just some of the illustrations that I do inside the house to show them what the options. This is an annuity, so they have a fixed annuity. I'm trying to present them with a new annuity that they're earning 5% fixed. They feel pretty good about that, but I'm able to get them, 8, 13% returns on this, and able to show them an illustration that yields that. So our illustrations outperform that. So there's another $250,000 annuity, plus I take all the outside stocks, bonds, CDs, everything else that they have, and I put it all in one big ball. Why? Because I'm going to show them to maximize the bonus. What sells when I'm doing these is the bonus, basically. Not just that, but the income potential, the less tax consequences and things like that. But at the end of the day, what's really selling is the fact that overnight you can take somebody with $300,000 and earn them $30,000 just like that. So this is literally all the paper that I went through inside a home. or several homes, to illustrate annuities, mortgage protection, and here's one with the timeline. This is a timeline. So this is a timeline to show equity. So I drew it out for them. You know, I put, here's them at age 61, here's them at age 71, here's them at age 81. This is 10 years, 20 years. Here's the equity built up in the house. So you can literally show them how much money they're going to walk away with when they sell. Guys, when you all get a chance, can you all mute out, please? So the great part about it, here's one here with the house. You got the house here. I'm showing them in this, the two people that they're going to be against, the children. Here's the kids here. So they want their kids to have the house. You know, 9 times out of 10, people truly believe that when they die, that the house just becomes the kids. Like they don't have to get a mortgage. Like the banks and the housing market's just going to insure the kids on the house. It doesn't work that way. So you have to inform them, look, your kids are going to have to get a mortgage on this house. It just doesn't become theirs and they continue making your mortgage payments for you. It's not how it works. So what we want is there's $125,000 in equity already built up into this house. So I got the house up here with $125,000 in equity. I got the kids over here and the bank over here. And I draw these 2 lines, wham, wham. And I say, look, these are the 2 people going to be battling over your home when you die. So if Mr. and Mrs. Jones, you went together, who inherits this? Who gets this home? My kids. 9 times out of 10, they say the kids or the grandkids. So with that being said, I put this drawing together and I say, here's the house. Here's the equity in the house. Right as of now, if you died tomorrow, the bank wants this. Why? Because they have $125,000 in equity, plus they're going to sell it for the appraisal price on the home, meaning that they make out big. So what you want to do is make sure that this is in place. For what reason? Why do you have mortgage protection for my kids? I have mortgage protection for your children so it can buy them time. What you're doing is you're buying people time. For what again? The equity built up into the home. It's not rocket science. It's very simple to get why we do mortgage protection. If you simplify it. Look, guys, if you can sell somebody on a $300,000 policy, then please go ahead and do it. You're covering the whole home. But it's very hard to do in some demographics. You got Florida, you got older people. It's very hard to get a 75-year-old $300,000 in coverage and it not cost $500 a month. You know, up north, it might be a little lighter. Out west, it could be a little lighter on the wallet. You may sell more. But the bottom line is that you most of the time, you are just buying people time. But if you could sell the whole premium on that to cover the whole home, then that's great. Like I said, this is everything I went through to illustrate what it looks like to work with mortgage protection, annuities, and why. I mean, this is all the drawings. And as I told you, if you guys illustrate this stuff in front of Mr. and Mrs. Jones, you are able to show them the roadmap that leads them to understand why they're putting this stuff in place. This might look like chicken scratch to you, but when we're sitting in front of these people, we understand what it means and what it's about. So long story short, make sure you're illustrating all this stuff in front of them and showing them timelines. And I'm going to show you how to do some timelines that show them how equity builds up in the home. Here's a little circle here that shows, you know, what are the annuity companies investing, or even life insurance companies. You got hotels, you got bonds, you know, you got stocks. They're so versatile. And I tell them, look, they have so many different investments. That's why they're able to get you that return. Is they're not dumping the money all into one place. So for 35 years, index annuities have been bringing huge returns back to people with no downsides to the market. Let the illustration speak for you, okay? So once you get to a point of drawing it all out, getting them to a position where they're willing to look at an annuity illustration, that's what's important, is getting to that point. Once you have found the money, a lot of people lack in what to say at that point, and it's just very simple. You say, Mr. and Mrs. Jones, I came here today to present you all your options. I want you guys to sleep on this tonight. I tell them straight out, listen, because I know that annuity sits, especially if they're big numbers, are going to take 2-3 sits, okay? But if you get back in that second or third sit, it's gold. So go for the gold. coming here today to present you all your opportunities, all your options. And that's why I want to do an illustration. Now, do you have a computer? Do you have a printer? And if they say yes, then you're gold. You just print it out. Contact your company, tell them how much money they have, and get an illustration. If you don't know how to do that yet, that's something that you need to learn. You can do a couple things. You can call your upline. You can learn how to sell these index annuities. You could do the second thing, which is even smarter, is call the annuity company and start learning how to do illustrations. They will teach you how to do this stuff. So I wanted to start out with final expense, even though I put it out of order. So I wanted to show you guys, I already showed people this in the beginning, but a lot of times people are buying time for mortgage protection. So that's what this is, 6 months, 12 months, and 24 months. I had another rep in the industry put this thing together for his own business, and he gave it to us. Here's 100%. Guys, mute out. Mute out. You got 100% of it being covered, or you're going to show them the timeline on how much they're covered. Mute. Guys, listen to me. You got to mute out, please. Lewis. 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 Oh, Christ. Sorry, guys. So I got a house on here. Hold on.
I thought it was an emergency. I didn't know what it was. I thought, you know. Okay.
Lewis, you have to mute out. You got to mute your stuff out.
I wasn't expecting anything at 6 o'clock in the morning, okay?
Okay, sorry about that, guys. I got a rep that just will, as you guys know, running a business is a little tough for this. So I'm going to try to get rid of him. Give me 1 second.
Right, 6 o'clock in the morning. Nobody else heard us.
You out. Lewis, mute out. You got to mute your mic out. Okay, sorry, guys. So what we have is, let me get started from the beginning. Let's start with final expense, okay? Let's go review final expense. I want to make it real clear on what you guys need to do to sell final expense. The biggest thing that people lack in is leads and carrier education. So once you have these two items put together, it's easy to talk to anybody about anything. Just for a conversation. You know, you get the lead, you contact Mrs. Jones. Hi, Mrs. Jones, I'm doing a follow-up call to that call that you had received yesterday about that final expense information you had requested. I'm the rep that handles that area. I'll be in your area tomorrow. Will you and Mr. Jones be available? That's the script. Don't make it all 4 pages long. It's as simple as setting an appointment and just do that. Learn the carrier. Get the education from the carrier. Stop blaming your upline for the lack of your sales. You're a 1099 CEO of your own business. Start acting like it. Get your leads, advertise your company, and contact the carriers for that part of the education. And when it comes down to the sales portion of it, your upline should take you to the field, and they should do videos or show you some way to get educated in a manner where you can walk into the home and sell this stuff. So make sure you jot down a big note. Get your lead resources in. How many leads do you need? Well, I can tell you this. If you order 20 leads a week, you're probably going to yield about $1,200 to $3,500. Now that's new agents, okay? So that's repetitively having this come in every week is what you need to do. For this number to jump, you need to do this lead order, and this is a low lead order, but if this is all you can afford up front, so what do you invest? You invest $300 here or so, you sell this, you make a few bucks, you reinvest this same $300 back the next week. So hopefully it turns out that the $300 you spent turns into the same $300 investment for your entire career. So don't think it's $300, $300, $300, $300. It's not $1,200 a month. It should be $300 flat, and then you make your money back, you reinvested it back into the business. And that's being educated in the sales process, and that may not happen overnight, but it should happen within month 2 at least, okay? So if you get anywhere from 30 to 40 leads, you should yield about $5,000 out of that. This is new reps again, okay? If you get 10, God bless you there too. So that's not impossible. But this is a lead order of what? About $600? Would you pay $600 to make $5,000? Sure, any of us would. But we don't trust ourselves enough. And that's why I do these videos, so you can get out there and trust yourself a little more. Anything above this, you get to the 40 to 60 mark, there's no doubt you should be at $10,000 a week, hands down, all day long. Okay, especially at 60. And your appointment setting becomes a lot easier. You don't have the frustrations of worrying about setting 20 appointments because you only got 20 leads. You could set 20 appointments, having 60 leads, and get to 10,000, and then you easily paid your $1,000 debt off, or $800, or whatever the hell it costs you to get these leads, $600. So at the end of the day, you've got to advertise this business. This is not free. You cannot get into this industry and do it for free. Now, once you have that, you set the appointment. You get to the home. You sit. You explain. What are you explaining? You explain their options. What are your options? And find the need. Do not take that word lightly. Do not ask them what, when I'm in a home, 9 times out of 10, I create that word. I create the word need. I show them where the need is. I look, 9 times out of 10 when you're doing final expense, it's about, burial coverage or taking care of cremation, but I'm showing them how to take care. I turn a final expense lead into mortgage protection and annuities. So I take it to new levels, and you should too. So I don't want to spend too much time on this, but it's very simply, you set the appointment, you get in the house, you sit with them, you explain, you find the need, you sell the deal. You can sell mortgage protection by showing people that there's a bigger need than just burial. If there is a mortgage on the home, then they should be covering it through mortgage protection and the burial coverage. If there is investments, then show them what to do with them. Like, again, say, look, I'm here to show you all your options. I want to show you all your options. You sleep on this tonight, and we can set another appointment. Make sure you do not walk out of a home after you show an illustration without another appointment. Be sure to set the appointment, okay? Thanks, Joe. Long story short, that's it for that, guys. I want to move into the big stuff, okay? Let's get into the mortgage protection portion of this. Mortgage protection, again, by the timeline. Here's the starting point. Here's the starting point. Here's 1 year. Here's 2 years. This is what you're buying people. 1 year. What do people need? Minimum $12,000. On the high end, $25,000. Over here, they need $50,000. They need $100,000. Even $75,000. Why? Because you're buying them time. What are you buying them time for? You're buying them time for the equity built up in the home. So let's say that this timeline does not mean that they've been in the home for 1 to 2 years. This means that's the timeline that you bought them to sell the home. Now let's take a look at something else. Let's look at how long they've been in the home. And let's take this. I want you guys to get this down so you can show people the math on this. Look, if you show people what I can get out to you guys too. Check out this little house. So if you're able to draw this, you can draw it too. But I got all kinds of illustrations you guys can use to help sell this deal. So you have this little house here, and it has equity. Now, there's 2 people after this. It's them, whoever's the survivor, and the bank. Now, if this person doesn't have enough money the very next month to make the mortgage payment, these guys are coming to get the home. Okay, it doesn't matter how much money's in it or all the mortgages that they paid in the future. Doesn't matter. They want their home. So what you need to do is buy them time, which we've already reviewed, but what does that look like to them? And this is the part you have to puncture their brain with. If a mortgage is $1,000 a month, multiplied by 12 months, they pay it for 12 months, that's $12,000, okay? They paid in a year. Now, that's not all equity. But I take this $12,000 And let's do it by a timeline. Check out this. Here's 10 years. Here's 20 years, okay? This is going to show the equity in the home over the time. So let's take this and multiply it by the 10th year. That's $120,000. Now, this doesn't have any interest. These are just guesstimates, just to help you invest into their brain the fact that they have this equity, but they don't see it. So if you show it to them, it becomes reality now. It's real, okay? You take that $120,000, you divide it by 2, and this usually gets you close to the equity that will be at that time, okay? So it's about $60,000 here. Now, with increased inflation, good times in the market, it could be $80,000 to $100,000. Over here, this could easily be $160,000. So, long story short, that this is what they want to. You want to show them what they're able to walk away with. So again, it comes down to the equity in the home. Now, is Mrs. Jones trying to stay in the home? Yes. And what you can explain here is, look, if you buy a large enough policy, if we get you anywhere from $50,000. Let's say this house is $250,000. If we get you 50, 75, even $100,000, Mrs. Jones, two things are going to happen. One, if God forbid you can't afford to stay here, and you'll already know this because I'm going to show you how to know this. But if you can't afford to stay here, one thing is that you want to be able to walk away with the equity in the house. So you're able to buy yourself time to walk away with the equity in the home. $50,000 can do that. Now on the back end, if there's on the 25th year or the 20th year, there's only $50,000 owed on the home, you get to pay the house off. Live there scot-free, or not scot-free, but just paying the regular bills. But you don't have a mortgage anymore, and now you're worth all the equity in the house. So if you ever get into a jam, you can sell the house. But what you need to worry about is time. Now, people always think I can split my home very quickly. Now, what about bad economical times, like 2008? There's nobody selling a house in 2008. But what you could do is buy them time to sell the house, which means give everybody at least 2 years. Now, if it's a tough sale, you can come down to 1 year and just say, look, let's just put enough money on the line. And you can do this, guys. It doesn't have to mean that their health is bad, too. You could sell a graded policy. You could sell, graded products to cover mortgage protection, too. It doesn't have to be large numbers. You can sell a $12,000 policy and it's mortgage protection, okay? So at the end of the day, you don't always have to cover this, but this is important to get. This here, all the way through here, doing the mathematics in front of them, getting them the equity inside the house so they have a picture in their mind of what to expect to walk away with if they are forced to sell this house. Now they know. They've never done math on this. I almost guarantee you most of them have never done math on this to see what the equity was. All they're worried about is covering the mortgage every damn month. Most people. So we're in the sale. We got Mrs. Jones on the phone. We say, hey, Mrs. Jones, you had requested some information for mortgage protection. I'm the rep that handles that area. I'll be in that area tomorrow at 2 p.m. Are you and Mr. Jones available at 2 p.m.? And that's it. The entire script is very simple. If there's any objections, it's usually the time. Most people will sit with a mortgage protection specialist. I mean, it is the largest investment. So you shouldn't have a problem getting into more homes than you do with final expense. It should be more sits, okay? Even though the lead's a little more costly, but the amount of premium that you pull from this is amazing. I mean, it's absolutely will double, quadruple, your numbers every year. So we have Mrs. Jones here. Again, this is the same thing we do. I don't know what age we want to pick, but I can do a little of both. I'm going to start with an older couple, like 65. And I'm going to go over this real quickly because I want to get into some questions with some people that I told that I would ask questions today. And I want them to ask questions also. But at the end of the day, you got 65-year-old Mr. and Mrs. Jones. Mr. and Mrs. Jones, what is the monthly mortgage? How much do you owe on it? These are some of the very first simple questions that you can ask. Monthly mortgage is $1,000 a month. How long is that for? 30 years. 20 years, 10 years. We owe $200,000. This is just, I don't know if all these numbers are going to match. This is just for illustration books. Okay, guys, Now, the next question is important. This is the part where I find out what money is coming through the house, okay, versus what's going out. I could easily, at the beginning, I haven't built rapport because they don't trust me yet, so you got to get rapport built. And how do you do that? You become the expert. Become the expert to build rapport, along with sharing some livelihood with life and maybe some pictures in the house. I'm not against that, but really, the truth be told, it's all in the magic that happens in front of them, which shows you as the expert, okay? So you owe $200,000, you got $1,000 a month in mortgage payments, you got that for the next 30 years. So out of the two of you, Mr. and Mrs. Jones, who has the two of the higher Social Securities? Well, who has the higher Social Security? And if they look at you strangely, and they may, you may want to say, because I'm asking due to the fact that the significant other is going to have 6 months to 12 months to wait for that money. That's the facts. That they 9 times out of 10 have to wait 6 to 12 months. So if they can't, they don't have enough money just in that period of time, they lose this house. So it's important to bring this up. Mrs. Jones has $750 a month in Social Security coming in. Mr. Jones has $3,000, and you will run into this. He has $2,000, whatever the case may be. I see numbers all over the place. Now we know total that they have $3,750 coming in, minus $1,000 due to the mortgage. That's $2,750 left, guys, to spend. All right? So at the end of the month, what's coming in? Now, that's what we want to know, is we want to get to what's at the end of the month. What do you have left over? Mr. and Mrs. Jones, do either one of you have life insurance? This is a great question. I hope they do. So a lot of you might be battling the fact that you hate the fact that they have life insurance, but I only hope that they do. And there's a reason behind it, is because I can usually fulfill something which is called just replacement of the policy, which is easy to do once you catch on how to do it. But what I can ask them is, sometimes they have multiple policies. Like this weekend, how about this? One of the sits had $1,000 a month in premiums for life insurance on each side, of $500 and $500, okay? Now, it's all term. So I find out that most of it's term anyway. One policy wasn't. But it's an index universal life. So the return, the cost of insurance is already crippling. So they basically have no life insurance. So at the end of the day, I know that it's 7 years they have left on these things, okay? And they're getting older. What do we want to take advantage of? We want to take advantage of their age and their health. These two are healthy. So then I can take this $500. Now, can I get them the $350K that they were waiting for? No, but they know it's not going to happen either. So they know that they have enough life in them to make 7 years. I take this $500. I find out what we can get them, and I think it's 150 over here, and it's 100,000 over here. I'm not sure. I might be way off. I know we still have to go back to the sit to bring the illustrations. I wanted to make sure that I was doing the right thing, because it was past 6 o'clock. There was only a certain amount of time that I could get a hold of each carrier. And that's why people selling on the weekends have trouble doing these, because you can't get a hold of the carriers to replace policies, to show proof that the policies are no good, that they won't stay in place, that they have cost of insurance, you know, that they'll term out, that they don't come with return on premium, things like that. So all we can do is hopefully get them something that we know is guaranteed to be there at the end. So we got 250, so we replace those policies. It's easy to do, and it's necessary to do. You can't have them going on with those policies because they're just going to die out. Guess what their investment is something like $42,000 over the next 7 years or some shit like that. So if you show them also how much money they're going to spend trying to get one of them $350,000, when his is all term, they're just spending money over here, and you know, or she's is all term, and when she voids hers out because she doesn't have enough money to keep these going, or she doesn't want to keep them going because he's dead, that they spend about $42,000 in the next 7 years on policies that probably won't be there. So the best thing for you to do is put something in that place that guarantees them a shot, at least a 6-figure payout, okay? So that's easy to do. That's why we ask for life insurance. So I'm going to say no life insurance, 0 here, 0 life insurance here. Now, do you guys have any investments? Does Mrs. Jones being left with anything else, like a pension or a 401k or 403b or thrift savings? Or is there anything else in play Mrs. Jones? No. No. Okay, so what do we have? We got to find out what at the end of the month was left over. Here's the important question to ask. What at the end of the month is left over? After you've paid all your bills off, do you two have anywhere between $1,000 and $2,000 a month left over? Which one are you closer to? After you've paid all your bills off, all your fund money, all your bills are paid off. Well, we have closer to $1,000. Now, are you between 500 to 1,000, or are you just closer to 1,000? We're closer to 1,000. All right, so now you don't have any worries of whether it's affordable or not. You know that they can afford it. Okay, there's some homes where you get to the end and they're like negative $100. You're wondering how you make it. So, you know, getting to this point is very important for you. You can also go over every bill. I have a sheet that illustrates every bill most people pay in a home: the mortgage, the electric, the gas bill, the car payments, the insurances on the cars, the food in the home, the tithing, charities, things like that. So you can get to the end, find out what money's left over. If I know there's $1,000 left over, I know that they can easily invest into this, So it's very important that you do this. So we know that there's $1,000 left over, but what are we going to do? What are we covering? We're trying to cover $1,000 for two things. We're trying to either sell the house or pay the house off. Now, with that kind of money left over, you can show them this option. But what I would still stick to is always asking Mrs. Jones, if Mr. Jones was no longer here, would you stay in this home? I have to be honest with you, a lot of people in the South say no. They want to go where the kids are. They want to move back up north. And up north, it's a little different. They usually have the home for 30 years. They want to stay in it. You know, they're not going to try to leave. You know, they really would prefer to stay in this house, live by their kids, their parents, things like that. So at the end of this route, what we're going to do is we're going to sell the house. And this is a simple way to sell. Why are we selling? A lot of people may ask you in the home, well, I thought this was mortgage protection. Well, it is. But you know what? I don't need to charge you to pay off the house when I know you're leaving. I know you're going to sell the house, so why pay the house off? Just learn to get the equity back out of it. And what I want to show you, Mr. and Mrs. Jones, is how much equity is built up over the years. And that's where you do the mathematical problem. So again, I'm going to erase this. This is like a sheet of paper for me, okay? So I'm going to take another sheet of paper out, and I'm going to draw this out for you. I'm going to say you have a mortgage, it's $1,000 a month. I'm going to multiply it by 12 and so on and so on and so on. And then I'm going to draw the timeline. Here's 10 years, here's 20 years. In about 10 years, this house will be worth about $80,000 with some inflation. It could be worth $100,000 to you. And this is what I want to make sure is that the two people after your home is, that's an ugly looking house there, is the bank. So Mrs. Jones, what we want to make sure is that you can afford to stay here due to the fact that his $3,000 a month is gone. Okay, you remember, Mrs. Jones, you only have $750 a month coming in. Your mortgage is $1,000 a month. We already know that you can't afford to be here. We must buy you time to sell this house. We got to do it. Now, we could also think about Mr. Jones making it to the end too. And on the 25th year, you know, maybe you have a $50,000 policy and he's able to pay the back end of the house off due to his demise. Great part about these products too, Mr. and Mrs. Jones, is that they also come with living benefits. So you don't have to worry about just getting the money while you're dead. You can also get it while you're alive due to heart attack, stroke, cancer. The list goes on. You can't do 2 or 6 living things a day, like walking, bathing, dressing, you know, toileting, transferring, things like that, that you also get the money while you're alive. So check out your carriers and know what they give in living benefits, because it helps to sell a product that you know. It really does. If you learn the products, it becomes a lot easier to do this. So you got $750 a month coming in. We want to protect this so you can walk away with, again, what are we doing, guys? We're helping them walk away with the equity. Why? Because the bank will snatch this up from her within the 3rd month. She's on the streets, okay? If you get somebody that tells you that I can have a child move in, you got to make them understand that the reality is I'm here to be the worst case scenario. Children die too. You can't always put that on them too. Those kids might have their own life. So let's just do the adult thing and let's protect you two while we can, okay? So you're doing the worst case scenario in the home too. If you don't know who to put this stuff on, put it on the person that is going to demise first, or the individual who makes the most in the house. So the breadwinner, basically. So that's it for that. Now, we asked about, benefits and things like that. If somebody told us that they had a 401k, the simplicity behind that is I want to ask this question. I want to say, how much is it leaving to Mrs. Jones? I never say how much is in it. How much is it leaving to Mrs. Jones? So I have $200,000. Okay, well, I can show you a way to, I'd like to show you all your options, like I said today, guys. So I'm going to do something here which will pay this house off in about 10 years. So how would you like to see something that could pay the house off in 10 years? Okay, we can do that. Or even 20 years, I should say. Because with the payments that they're putting into the house, plus 10 years, they could probably pay a $200,000 house off. But let's say in 15 or 20 years, they would like to see that. I'm going to show you a way to pay the house off early. Would you be interested in seeing that? Yes, I would. So what you're going to do is an illustration. You want to show them just in 10 years, just on the illustration, that this would be a bonus plus 10% on the good products. So you're taking them to $220,000. Write this down. Say, I'm going to get you 20,000 bucks today too. So I'm going to show you how to make a little money. There's no losses, only gains. The taxation is less. It's amazing. It turns into life insurance with smaller taxation to the interest earned on it. You got to get out of this because if God forbid we take a hit and you take 30% out of that, you're doomed. You don't have enough time on this earth to get that back. You've got to protect what you have. Protect what you have, okay? So I'm going to show you a way to make some money, never lose another dime, and this is what the new 401k looks like anyway today, okay? So in 10 years, you're talking about having $440,000. Now, this will show if you were with them for the past 10 years, if you were doing this for the past 10 years, this is where you'd be, okay? That's the facts. And you can show that in the illustration. So let the illustration do the talking for you, okay? You need to walk them through it, but they have 10-year boxes here. So you can show in the illustration the past 10 years, the highest earnings, the lowest earnings, the most recent, things like that. And you need to know who to use. So I'm not going to call out any carriers, but if you don't know who to use, you need to contact your upline and make sure that they're smart about this too. Because if your upline's not selling annuities, then they're probably not the best person to ask, to be honest with you. So find somebody that's selling annuities, find out what they're using, find out why they're using it, and start to learn how to use it, okay? But at the end of the day, all you're doing is showing people illustrations, and you're opening the door to that by getting in with mortgage protection or final expense app, and easily walking away with 1 to 5 of these a week by doing this. And if you sell 5 a week, which is very possible to do, it's a lot of paperwork involved, but you can pull it off. You can easily do $50K to $100,000 in a week. So if you want numbers like this weekly, we'll do what I tell you to do, and you'll start learning this stuff. But you can't do this unless you get the mortgage protection lead, you get the final expense lead, and you market your company. You've got to market your business. Please start marketing your business heavily. If you open the doors to whatever, a fitness studio, and you don't have the marketing in place to do that, nobody's going to come through the door. You're going to get a couple stragglers. You better hope that place is in a great spot on the side of a road somewhere on a major highway to get a lot of people in. But without marketing, no business works, guys. You just can't depend on referrals all the time and word of mouth. That's such BS. It just doesn't work that way. Word of mouth is the best advertisement. Yes, if people are talking about you, but what are they talking about somebody new for? They don't even know anything about you. So get your name out there. You can use social media too, but that's not going to kill you to use. So we have this plan in place. We got these strategies that we use. They work. And if you don't believe me, just look at the numbers. They're proof. Okay, we're not lying to you. I have proof of others doing the same thing, and it's working for them. I don't think that with all the talent that's out there, I just don't think that we're all using it. All of our talents, all of our skills. And meaning, if we could go the full distance, we would study the hell out of these carriers. I mean, seriously, when's the last time you called a carrier up to ask them questions about their products? Or you called your upline to ask about sales strategies? Maybe they don't have the strategies that you need, and that's the problem too. Sometimes it lies in that. But I'm always here for you, and I'm always here to contact. So you should have all the strategies in the world. You can watch the hell out of my videos, get the nuggets that you need out of them. And if you don't do it that way, just come to one of my conferences or seminars, and then also ask the questions via text if you want to. So what I want to do is let me see who's on here today, guys, and let's see who we got. Faith, hi. Ramon's back. Ramon's back. Oh my God. Okay, so we got some newbies out there. What I think that all reps should do is maybe spend some time with their upline. They need to get out in the field. That's important. So what I want to do is I want to ask questions. Anybody have any questions that we need to answer about any of this stuff? I want to get you guys to a $10,000 a week next week. So let's ask some questions. Well, how do we do it? Now, if you're not, obviously, if you're going through contracting, you're going to have a rough time doing that. But what do we need to get you there? How do we do it? Tell me what your leads or orders are. Be honest about it when you're asking. So does anybody have any questions to this point?
Yeah, I have a question, Jason.
All right. Go ahead.
Who is your favorite annuity carrier?
See, I don't want to talk about annuities on this because I get a lot of people from different companies. So what I can do is I can answer that question. It's obviously with one of the carriers I sent to you if you're part of my team. So I will go over that outside of this, but I can speak about some great companies out there. I'll do that to get around this, okay? So there are great companies out there. One of them is called Athene. Enough said. But there's others out there. I mean, you got to investigate this. Number one, who's gonna take care of the client best is one of the biggest questions you need to ask yourself. Do not start to, hey, who's gonna pay me the most? I've seen people hurt people. They've gotten them. I wish I could go behind some of these people who've gotten people a fixed guaranteed 3% or 1.75% because their pay was bigger. And I've seen them sell $1 million annuities doing it this way, which pays them close to $100,000 payout, or even $50,000 to $100,000, depending on their contract level. So that's not right to do. Okay.
And
so
this is my boss. Here's my boss.
What's that? Hello, guys. Can you mute out if you're not asking? So, go ahead. Any other questions, guys? And let me tell you why. I'll explain why you should have a favorite, okay? One, they need to come with big bonuses. They got 10%. That's a big one. There are companies out there that have higher bonuses, but strategically over time, who has outperformed all the other companies is the question. So when somebody puts 100K in here, will it be 200K by proof of the past? See, that's all you're doing this upon is the proof of the past, guys. You can't tell them it's guaranteed to do this. Don't ever do that. But what you can do is it's almost guaranteed because of the proof of this past. I mean, it's been like 35 years that these things have been around, and they have been outperforming most stock-based products. If you see the markets like this, so when somebody's no longer matching, they have these downsides to worry about, and they only have this much time left on the earth. You know what I mean? So the protection is important. That's important, never to lose a dime for anybody. So these are not variable. We get them to the upsides of the market. Everybody wants to sell annuities. Why? Because they pay big. And if you get a good contract with them, we give great contracts out for their annuities, that you can make a lot of money. I mean, you can sincerely, this is no bullshit, that you can make $50,000 to $100,000 a week by ordering the right leads, by sitting with a lot of people, and with those people. Now, look, in some demographics, you may have to switch your game up. Now, a lot of people don't have the benefits of living in a place where there's a lot of retirees. But you know what? I've done this in several states, so I can't say that. A lot of people make an excuse that there's only young people that they visit, and I say that it's just impossible that you're not with older people too. These days people are buying homes at all ages. So there's a lot of structure. But if you get young people, you need to enforce the index universal lives. Okay? Get high interest rates for these people, get great living benefits, and get great payouts for yourself too. But at the end of the day, you want to grow them a retirement plan then that they can place into the index annuity one day. So you make a client twice. You get this number built to get it into this at retirement, so you make a client twice. That's important too. Get the index universal lives with the higher interest rates on the cash value earnings. You get 7% and up, and they're gold. But you have to teach them how to over what? Does anybody know? That's right. Overfund.
I'm learning.
There you go, baby. So you got to overfund that, man. And with that index universal life product, whatever carrier you're using, you got to make sure that usually that you want something that has either high interest rates to pay out, or you can have great benefits and a little lower interest rate if it's for the benefits they're looking for. But if it's not the benefits, find the highest interest cash earnings possible, have them overfund it. What else should you do? Do one on yourself. Do this once you're in the game. We have a few of these on ourselves. And why? Not because I'm hoping to die, but because I'm hoping to retire. So you put these on you, you overfund them, and you make a mint. So you stuff an extra 100, 200 bucks. You got to find out what the max is you're allowed to overfund without it becoming a mech. But you have to be careful on that. But you call the carrier. That's what they're there for, man. It's like if you have a little store, you know what I mean, and you need your chips and you need your soda and what have you. You call the company up and say, hey, look, where's my order at? I want to know something about the product. I need to know, is this the better chip? Is this the better soda? Is the price right? But so that's what the carriers are there for, is to get you the information that you need to sell big. Guys, you're not taking advantage of the house and the need. I gotta go back to something here. This word need is very important for you to understand. A lot of people think that they understand the need when you walk into their home, but they don't. They don't see your vision behind this and all the other illustrations that you put together. One, there's the death. We have to cover that. Number two, there's the mortgage. Now, if it's not a mortgage, it could be rent. Somebody still lives in that place, they could have to pay rent. Number three, there's the income from it. The potential walking away after the house is paid. What do I tell clients? I say, look, all this is a savings account. At the end of the 30 years, you're just going to walk away with a bundle of cash. It just adds to your retirement. So you pay the house off in 30 years, whether you're using ROP type products, or you're using the index universal life products, or if you have to, you use final expense. But show them there's 3% on the cash value. You guys are not talking about cash. You're not telling them exactly where their money's going and what it's doing for them. And that's important to know. Hey, Mrs. Jones, when you buy a final expense policy, I also want you to know that every time you make a payment, a portion of that money goes through 3% earnings. So as you pay this over the years, you have the ability to take loans from this if you get into a jam, but you also have the ability to walk away with a big nugget at the end. So if you're paying about $100 a month, and let's say $50 a month is going into this, you can walk away with a substantial amount of money in a few years. So you have 6 times 10, you have $6,000 built up or so. Maybe that's the number, if that's correct math. You get about $6,000 in 10 years you can walk away with. You don't want this product anymore, you walk away with that. So teach them about the cash value portion of the puzzle. It'll help you sell your products more. You'll sell more products doing it this way. Promise you. Don't always just focus on the death and what the payout does. You also need to inform them what their money is doing. When you hand out money to somebody, do you want to know what it's doing? If you purchase this Gatorade, so plug the Gatorade. You purchase this Gatorade, and you know what it's going to do. It's got electrolytes in it. It's going to soothe that parched throat of yours. Somebody taught me the word parched, so I've been using it like a geek lately. So at the end of this thing, man, we got the death, we got the mortgage, we got the income basis, we got the living benefits. Talk about the living benefits. What else do we have? What else can we benefit? How can we teach people about the need? And then, but how can we teach people about the product and the need? What else can we teach them? Oh, here's a good one. Here's a great one. I'm going to teach you how to make one policy, 2 people's product, okay? So I have Mrs. Jones paying $100 a month, and let's say she's got a $50,000 policy, okay? This is just a hypothetical. Now, not only does this thing earn, I don't know, depending on which product we sell, let's say it's earning 7% interest on the cash value, then it comes with living benefits. And let's say Mr. Jones has a policy too. He has a $100 a month policy. It comes with cash value. Cash value is equal to this interest. So he has the same stuff too. Now, Mrs. Jones, Mrs. and Mr. Mr. Jones passes away. Okay, it's 20 years down the line. This thing has a big ball of cash in it. Mr. Jones dies now. Mrs. Jones doesn't need her policy anymore. So not only does she walk away with a $100,000 payout from his policy, but she may walk away with $20,000 depending if they overfunded this policy, from his cash or from her cash value. Do you see how one policy can become two? Now, if you're just selling one person, you can also do the same theory. If Mr. Jones, Mrs. Jones, I'm going to put this on Mr. Jones, okay? This is on your husband. However, if you were to die before him, and let's say it's 20 years down the road or 10 years down the road, there's probably about $6,000 built up into this, maybe even 10. Mr. Jones walks away with $10,000. So it's kind of like two policies in one. So if you were to die before Mr. Jones can take the cash value out of this policy, okay? Because it's on him. He doesn't need it anymore, all right? So that's how we do that, man. So they've got two policies in one, very strong strategy. Somebody called me Trey. My name is Jay, man. So you got not Trey. All right. So what other questions can we handle today? What else can we talk about? Let's take our time, right? We got a $10,000 week coming up. Maybe it's not next week, but it's the week after. So when you get to that lead, go ahead.
This is Paul in Chicago.
Got it.
Any work with single premium annuities?
They're all single premium. So basically, meaning you're putting $100,000 in, one premium. They have, so you guys are aware, they have usually 1 year to put more money in. So if they get this, they get a bonus, they get $110,000 to start with. They put it in there, they have 1 year to add on to it, but you don't get paid on that, you just get paid on this. So what is 6% of 100 grand?
6,000.
6,000 is right. That's what you would be paid. Now, that's what your pay is. Now look, how easy is it to get you get close to 50 grand if you sell 5 of these in a week, you're talking $30,000, right? So if you sell larger, and you will run into 200, 300, $500,000, $1 million. 6%, 100,000. We got 1, 2, 3, 4, 5. So on 500,000, you're paid 30 grand. So you find it's the same thing. It's just more money that they're putting away. I mean, it's the same as doing 100 grand, guys. Nothing changes. It's just the amount. Don't be afraid of that number. Stop the fear. A lot of people see these numbers, and I still do. I get a rush off them. Wow, they got that much money, and it's like, I'm a kid from the streets, and it's, whoa, that's pretty heavy. But at the end of the day, I got to cool it down. I got to say, I'm a professional. I've seen this before. This is great. Did you have this? Because guess what? Guess what they get to start with? $550,000. How would you say this? Hey, Mr. Jones, how would you like it if I could make it 50 grand today? You want to take a look at something? Most people say yes, and that's just like a little joke that I put in. It's just like playing with them a little bit. But at the end of the day, would you like to see how you can make 50 grand today? And then not only that, let's add 8% onto this. Or how about a small number? Let's go 7. Let's add 7% for the next year's earnings. How much is that? Anybody got a calculator handy? $550,000 plus 7%. Anybody got that for me, please? 6% is 30. It's about what, 40 grand? So in 1 year, you took his money and you added $90,000 onto it. 1 year. This guy makes 90 grand, or Mrs. Jones, or the couple. You show them a $90,000 return in 1 year. That's going to be incredible. Am I right by that, or am I wrong? 550,000 plus 7%. Is that close or no? Am I way off? I might be off. But long story short, you show them 570,000, whatever the hell the number is. They're going to be happy with a $70,000 return in 1 year. Guess what? They can't ever lose it. So the question is, how long would it take your 401k to get you to 70 grand?
Too long.
Yeah. So that's what we do. Guess what? Your 401k, if we subject this to big losses, if you lost 30% of $500,000 due to volatility, hard volatility, it could happen. What would you do? You don't have enough time on earth to get it all back. Why would you take a chance with that much money? I have found $600,000 within the past year in somebody's savings account because they didn't trust the market. Now they had 1.2 million and they lost $500,000 in the market over time. So they were just done with the market. But check that out. I'm able to get him what, $660,000 and turn this into like $720,000 in the next year. I mean, that's incredible money. It's like free. So, you know, get yourselves income, get yourselves money, guys, so you then can too participate. Doesn't talk to you, but great stuff. Oh, okay, I'm sorry. I thought you were calling me. Oh, somebody else's Trey. I got you. Okay. Any other questions? Paul, what are you doing this week? You going out? Who's going out? Faith, you on here?
I'm going up this week and every week, Filthy.
Okay, man, good, good. And then here's an illustration. I put an illustration together for you guys. Well, this is real. This is an actual client. This is what the front page looks like. Okay, well, I'll explain it to you. It says, what does this annuity illustration tell you about annuity illustrations? The hypothetical contract values are calculated based on historical index prices. Assume that the index will repeat its historical performance. They're able to repeat this because they're so versatile in what they're investing into. So that's why it's a great product. You know, it's absolutely gorgeous to them. This one gave them a 10% bonus. So right out of the gates, they're starting at, here's the interest levels here. Let me get to the page. Freaking hands are sticking. So when you're able to show an illustration like this, and I'll go over this a little closer, but let me get it from a distance. You got 7.94% historically average to earn, okay? So they're showing these numbers in an illustration. Do you think for 1 second a company this large wants to show illustrations that they can't pull off? No is the answer. They're going to hit these numbers. Will they hit them all the time? Maybe not. But will they even increase? Yes, they'll hit higher numbers also too. But you know, could it be lower? Yes, absolutely. But at least they don't lose anything. They don't lose a dime. So at the end of this puzzle, when I take a look and I go through this person starting at age 54, there's $250,000 in here. Now when I come down here and I go to age 64, and I come across here, it's $540,000 now. 10 years. Their numbers aren't doing that for them. It's just amazing. And guess what? That's the death benefit too. So they're able to leave that behind. Actually, check this out. At age 63, it's about $515,000. But the death benefit is $540,000. Now it comes across at $540,000, and then the very next year after that, at age 65, it's $629,000. Now at age 73, it's 1.16 mil. So they can be a millionaire in their lifetime. You can actually show people how to be a millionaire. And the great part about it is we're going off historical proof. Now, if they made it to age 94, it would be $5.3 million put away. So imagine if this, and they don't need to touch this, by the way. They're letting this ride. And if they make it to 94, their beneficiary receives a $5 million check. Even before that, let's go to 80. When most people die, their beneficiary is going to get 2.1 mil. So, and she's healthy. So it's fantastic that they're able to do this, and then if they want to survive on this, here's what else this does. You can instantly gratify them by turning on the fountain, which is the money. You can instantly turn the money on to this while they're earning high interest rates, while they got a bonus, and they can start working off the bonus to start bringing an extra $1,000 a month home. This kind of policy will not only, it will probably lose, within 10 years, it probably wouldn't be $500,000, probably closer to 300 grand or so if they were to take $1,000 a month out for 10 years. But it could be closer to 400 grand. So think about it. They're able to, in 10 years, they're able to double their money plus pull an extra grand a month out for the entire 10 years. You know what I'm saying? That's crazy. That's bananas.
Hey, Jason.
Yeah.
So do you have, when you go back to the home, do you have any objections in terms of when they potentially are looking at, videos on YouTube, because I've seen them there that talk about how IULs are a bad investment due to the cost of insurance, et cetera,
Sure.
et cetera?
The best way to get around that is inform them from the beginning. There's a lot of people that don't know what they're talking about. What I advise you guys to do is contact the carrier. If we want to think about it, the best solution for you is get the voice of the carrier involved. So without a doubt, if you're talking to this $33 billion company and you're on the phone with them and they're lying to you, you can sue the hell out of them. That's the benefit of it. If they're telling the truth, and they are, is that historically, right here is the proof of the 10-year historics. It says the geometric mean assumed interest rate was 8.4%. And over this 10-year period, if they did this, over the 10 years, they would be at $564,000 now, today. So in the past 10 years, if they did this, they would be at $564,000 now, running off of their $220,000 investment or whatever the hell it was. 272 with the bonus. So long story short, yes, you're going to get people that go online. But guys, we're talking about the internet here. Show me which video you watched, and I'll show you a video that tells you the different side of that. I'll show you a video that's positive. Now, what you all need to do is put videos in your storage to make sure that a day like that comes that you have the backup to prove it. Okay? So I have something like that for you guys. It's pretty cool. So I can bring that to the table. There's also good, if you go to YouTube, there's good and bad, videos to watch. You guys want to see a good one? Let me turn this around because I gotta have Facebook involved here. I'm going to show you guys a good one that's kind of cool to use, and it kind of explains this. Really, really neat. Go to YouTube and find out what's a good video to watch is Annuities. Now I hope this is a good one. Sometimes there's a bad one.
When you think about the years ahead, what are you looking forward to? For most people, the answer is a nice balance of favorite pastimes and new adventures. Busy and tranquil moments. Balance is also important in your financial life, between reward and risk, nest egg preservation and growth. No one knows what the future holds. That's why index annuities attract the attention of retirement savers looking to achieve some balance and peace of mind, no matter what happens in the financial markets. In 2008 and 9, Americans lost an unprecedented amount of retirement savings because of stock market volatility. Those who own index annuities lost nothing. So what are annuities? and specifically indexed annuities. All annuities are basically a contract between you and an insurance company. You pay for the annuity in either a single lump sum or multiple payments over time. In return, the insurance company promises to pay you money for the annuity in a single or series of payments. Like many other longer-term financial products, annuities have a surrender fee for early withdrawal, the terms of which depend on your contract. There are two categories of annuities: fixed and variable. With variable, the consumer assumes the risk for the annuity's value, and with fixed, the insurance company assumes the risk. An indexed annuity is a type of fixed annuity, but it has a distinct way of calculating annual interest, using a formula based on changes in the performance of a stock, bond, or commodity index. The index is used as an external benchmark. You do not actually invest in it. While the interest you earn, and when you get it, depend on the features of your particular contract. Generally, indexed annuities have an interest rate floor, a participation rate, and a cap that determine the amount of interest you earn. Your interest earnings rate always remains somewhere between the floor and the cap. It does not rise above the cap, even if the index goes high.
Okay, I don't want to keep that rolling, but you guys can go back to that and study that. But you should see that's just a cute way of showing people that there are opportunities out there to index your products, and basically you need to teach them the difference between indexing and the variable side of the market. So those two things are very important for you to bring up, which is the index and knowing that they are variable. Now, what is the difference? Well, this one means you mirror the market. You're not participating in the market. This one is in the market, so it has the downside market potential. Now, sure, you can participate in the upsides, but you will participate in the downsides too. So leveling this off across the board, most retirement funds, even though people will be like, well, I earn 16%. No, you're wrong. It's break season for this. Yeah, sure, but what if your losses over the years, it took 16% just to get you back in action sometimes. You know, a lot of times they may earn some money, but Mrs. Jones, the point of the puzzle is these downsides. There is no way to avoid them. Yes, you will participate in the upsides, but you also participate in the downsides. Plus, there's fees. They do not run this for free. How much in fees do you get charged every single month on an annual basis, whatever the setup is? Is it 3%? So I had some woman told me that they're earning 5% fixed. It's variable though. She's trying to explain this thing to me, which she doesn't know. And here's the better part to do. Best thing you can do to win this over is get a hold of that company and prove that they don't have what they think that they told them that they have, wherever how you want to think this out. The rep may have told them something just to sell the deal. That's a possibility, just to make a commission. Sometimes that's the possibility. So you have fees involved. If you're earning 3%, Mrs. Jones, or you're earning 5%, that means you're taking home 2%. That's not good, okay? So what we want to do, just what you need to do is explain to them, all we're doing is taking a look at an illustration. It's so you know all your options, so you can really lay down tonight and think this over, or take a week out of your time and think this over. Faith, when you do this, you're going to run into issues along the way. Look, if I sold every annuity that I walk into, I'm telling you guys, I talked to, adding the one yesterday on, no, but Thursday, I'm sorry, so yesterday, Friday, Saturday, I walked into 11 talks, okay? 9 sits, 6 sold. So 11 talks about it. That's 11 illustrations I've done, okay, to get to that point of 6. So that's about half. It's almost like the same as the game of life insurance if you're bad at it. So, you know, these are the numbers. Now, can I make this better? I'm sure I can, and that's what I challenge myself to do. Is that kills me not to do that. Knowing what I lost, hell, that's $200,000 in a week I lost. $200,000, guys. $200,000 in about a week and a half, maybe 2 weeks. So if I'm able to pull this out of people in that amount of time, now this doesn't always happen to where I'm sitting with or talking about this 11 times. It's an interesting pattern that happened, but I can guarantee you that I'm guaranteed to find 1 to 5 a week. Now, even if I sell one of them, that's in between. Like the lowest amount I can earn is $1,000. It's selling like a $10,000 one, you know, or $600 to $1,000, depends on the contract level. But on top of that, I mean, the big ones, you know, that you go for is you got the $1 million one. You know, it's going to pay you monstrously. We had a guy in our group that sold 1.2. You know, it's like 80, 90 grand it paid him. One sale. So they're out there, and you're never going to find them if you don't talk about them, you know. So how do you get to them? Can anybody tell me how do you get to an annuity sale? Anybody know? Tell me, Alyssa, how do you get to one?
Through leads.
So you ask them.
Yes. Go ahead.
You ask them if they have anything in their retirement fund, if when they retired, if they have a 401k, if they have any kind of investments.
Right.
You have to just ask some questions.
Yeah, but yeah, well, you're both right. But the answer I was looking for was what you said on the webinar. I can't tell who's always screaming out things to you guys, so I apologize. But listen, that's the answer. That is the answer. You get the leads. What are leads to your company? What is a lead? What does it mean to your company? What is it? It's like it's just a way to
Your bloodline, your bloodline.
It is that. And it is your marketing to your company. You cannot do this game without marketing. You got to market the hell out of yourself. So getting that bloodline, that lifeline, those resources to this puzzle that leads all these little strange pieces that you have laying on the board, and they all come together to make this beautiful picture. And at the end of this picture is like what the picture says is it says this huge dollar sign on it. You know what I mean? And that's the game. Put all the puzzle pieces together to get this money. And while you're doing it, remember this. If you're doing it right, you don't have to cheat. The money pays you so well, there's no reason to cheat. The illustrations are perfect. I mean, here's what you also need to learn how to explain, by the way, too. I want to add this in there that, you know, they have this bonus and everything, but they have these vesting, they have these withdrawal charges and premium bonus vesting percentages. They have a chart here, a contract year, 1 through 10, and it shows you how if they pulled the money all at once, that in this situation, they would be taxed 12%. So down the line, if they have 4% on year 10, so at that point they've earned so much interest, it probably won't matter if they put, you know, hit them with 4% at that time. But you have to make sure your client knows and say, look, if you're going to do that, let's not even do it. Why would we do it? No, that's a takeaway. Let's just not even do it if that's the way you're thinking. And so if you need to pull, let me ask you, Mrs. Jones, why in God's name would you need $120,000 next year when you've never needed it before? Well, I don't know. I might need it. Okay, well, let's, you know, maybe we shouldn't. Maybe this isn't the right time to do this. But at the end of the day, look, Mrs. Jones, I'm showing you a way to make $12,000 today, protect all your money, still have access to enough that you can get by. Next year, let's take $12,000 out. Plus your income yearly or annually or monthly, you know, is $3,000. So you can add an extra $1,000 onto that. And you pay taxes on interest earned on this money, on the seed, not the harvest. This is important words. This is the insurance language. This is amongst what you need to be learning to get this down right, bud. All you people out there in life insurance land, learn that word seed and understand it, man. Get that down. It's very important. So, what other items do we need? We got our marketing strategies, okay? Who's having a tough time on the phone? Anybody having a tough time, you know? Anybody having a tough time on the phone at all? Has anybody got leads to even use the phone? We got leads yet?
Yes, I do have leads.
Okay, great. Now let's take a picture of your leads. Let's look at your leads. How many leads do you think you have?
Right now, I have about 150.
150?
150, right.
Okay. Out of this number, even though that's a big number, I'm going to show you a small number, okay? If these are older leads, he should look to sit with 10 to 15 people on a high. This is a low number now. Listen, I got a reason for this. If he only sold 5 of these out of all this, but he learns how to sell larger premiums, it doesn't matter. He sat with less and he did it right. You sit with less, you sell more, and you make more. How does he sell more? He brings the need to the table. He's not waiting for the need to come to him. He's not asking, Mrs. Jones, I know I'm here for final expense arrangements, but also we want to look at investing some time and checking out the future if, God forbid, Mr. Jones is no longer here. So some of the questions I have are like, do you have a mortgage? Yes, we do. So should we look at maybe taking a look at buying you time? Would you live in this house if he was no longer here? No, I would leave. So you would sell the home, is that correct? Yes, I would. Okay, so what we want to do is we want to take a look at not only taking care of his funeral and burial, but we also want to take a look at maybe covering this mortgage for a time period. So because you're going to lose his income, right? You're going to lose Mr. Jones's income. His income is gone now. So by the way, Mr. Jones, about what is your income to Mrs. Jones when she receives your Social Security? You're the higher of the 2 Social Securities, or Mrs. Jones or you? I am. So she loses about $2,500 a month. Mrs. Jones, what's your Social Security, just for number reasons? I bring in about $1,000. Now, what is the mortgage monthly? The mortgage is $1,200 a month. So did you guys know that to get his Social Security, it's going to take 6 to 12 months' time? Oh, no, we didn't know that. Yeah, you're going to lose his until 6 or 12 months. And if it's 12 months, it's bad. 9 times out of 10, it's in between the first month and 6 months, we hope, but it's taking 6 months. So you have to ride the waves out on $1,000 a month, maybe. Guys, do you have anything else in place? Mr. Jones, are you leaving her anything else behind, like a retirement plan? Yes, I have. I was a teacher. I have a 403B. Okay, great, wonderful. And what's that valued at for her? Is she going to be able to buy a long distance of time, or is it just buy her a little bit of time? No, it's worth about $250,000. Okay, great. Now that I have all this in place, guys, I'd like to do some illustrations for you to show you all your opportunities out there and make sure that you guys have pieced this puzzle together properly so none of you lose the home or don't have enough money for your future, okay? Yeah, sure. Okay, and that's where I'll call the company up, get an illustration on $250,000. Why did I do that? I'm there for final expense, remind you. Now I took a burial coverage down to the fact that it has an annuity. You get it?
Yeah.
Right. So you become Columbo, man. Anybody know Columbo? All those old cats out there?
Yeah, we know Columbo.
My man. So yes, you got to go Columbo on this, man. And puff on that little cigar and get your little, get yourself in there and you get those numbers out. You want to find the need. What else do we need to find inside the house? We find the need. We find the need. You create the need. Let's put create the need. I want you all to be so good at this that you're able to take it from finding the need, which is a part of the puzzle. Let's get to know what they want to know too, but create the need. That's where I took a final expense, a $7 frickin' lead, and turned it into an indexed annuity that will now pay me $20,000. Now on top of that, say worst case scenario, your contract level's low, you get $15,000. So at the end of this puzzle too is the fact that I'm going to teach them how to get this final expense / mortgage protection in place using this instead of using not my pay, but using their interest earned on the annuity to pay for the product, so it's not out of their pocket. So, Mr. and Mrs. Jones, I'm going to create something that doesn't come out of your pocket, that protects you from all downside market volatility, that you pay less in taxes, you participate in 8 to 13% annual earnings, you get a bonus up front, so you're going to start at about almost $300,000, $275,000. So you start at $275,000. By next year, you'll be roughly at close to $300,000. You can still have access to your money. You will not participate in any downsides of the market. Only proof that I can bring to the table is the 35 years they've been doing this. So in 10 years, this will be $600,000 with proof of the history that it's done in the past. I can only show you proof, okay? So I'm going to show you the proof. It's always been there. It's just the 401ks were a better option for companies, not you. So what we need to do is take this now and do what they call it's a new 401k. It's the way of today. You got to do it the way I tell you to do it, because if Mr. Jones, you pass away and Mrs. Jones loses 50% of your money overnight due to market volatility, she's going to be in a bad place for the next 20 years. All right? It depends on their age. Now, I haven't spoken much about young people and what to do. So I'm going to touch on that real quickly, and then I'll give you guys your weekend, okay? Just give me a second to touch on that. Now, if you have any questions, I advise you to ask. Please ask me. I don't care what it is. It's not dumb. It really needs to be asked. What do you need to be asking? Go ahead, man. Hit me with something.
How do you get through to these young people? Some of them just don't want to listen.
Yeah, good question. Okay. Here's how you do it. You do it with big numbers. Now, if the young people are, in between 20 and 30 years of age, you have to use enthusiasm sometimes to say, look at this money, man. Check this out. I want you to see something. If I take $100 a month, we're spending it already. Let's be honest with ourselves. If I could easily tell you spend $100 a month. Man, check this out. I got a Gatorade here and I got a Red Bull here. If I drink these two items every day, it's costing me about $100 a month. So we all spend this $100. I'm going to teach you how to spend it smartly. So when you're, 50 years of age, you're able to retire. Would you like to retire by 50 years of age? You're 20-some years old now. So think about this, because that time's coming. I promise you, I'm 40-some years old now, and I never thought I'd be 40-some years old. So here's what we're going to do. We're going to take this $100. We're going to put it away into a savings account, okay? We're going to watch it grow. I'm going to get you about 7% return. So I'm going to show you something. If I take $1,200 a year, and I teach you how to add a little something to this. So this is just going to get your girl, so maybe there's a girlfriend. I'm going to get your girl covered for $100,000. She's going to have, you're going to get $100,000 out of this. Or vice versa. She gets $100,000, whatever it said. Long story short, we're going to take this and we're going to teach you two how to overfund. If you do this together, you do $100 you, and you do about $100 her, that's $2,400 a year earning at 7% interest. And over the years, I do 10-year look on this as $24,000. What's 24,000 times 7%? Damn, I need a calculator. What's she never
More than enough to figure in my head.
Yeah, right. So we got 24,000 times 10 would be 24. 70%, I meant. 70%. 24,000 times. This one's 4,000. Let's say it's 60. I don't know, $60,000, 50,000. I don't know what the hell it is, but it's something like that. So long story short, just in a 10-year period, you can have that amount of money put away. Now, what you're going to do is you show them the illustration. So you have to find a way to get an illustration in the house, and this is the part that a lot of people aren't. Is it, Juan? I meant 70% on that, bud. Long story short, what we need to do is find a way into their mind. So you show them the cash value sheet. The illustration will have, over the years, it'll say at age 24, this will be worth, $1,200 in cash value. Maybe it's zero at that time. They really don't pay out in the first year or 2 years. So it's $1,200 in the second year. The third year, it's $2,400. Second year, it's $4,800. And the money just keeps going up and up and up over the years. And then you show them at retirement at age 50 what the number would be. Now, that's not them overfunding. So if you can, call the carrier up and try to get a number that shows an illustration of them overfunding it with $100 a month. And show them what that looks like at the end of that ride. That's how you do it with young people. You index universal lives, not final expense. They all qualify for it, and they all need to overfund it due to cost of insurance over the years. So they need to teach them every year. Maybe you contact that client and say, hey, look, man, remember that policy we did? Are you overfunding it? Yeah, I am. Well, do you have any buddies that might be interested in the same thing? Friends or family that I can talk to about getting them this same style of investment? Yes, I do. So it's a great way to get referrals every year if you're working with young people. But I want you to use the Index Universal Life, guys, on the youth. Either that, or you can do the ROP, for that return. But if they do this smarter, this will be larger than this. This being put away is like, $30,000 at the end of the ride. This being put away is like $120,000 after the ride is over. So it makes a big difference. Any other questions? How's your presentation? Everybody good in the house? Good on the phone?
Yeah, because they don't have roaches.
Yeah, the roaches get you, man. That's the stuff you just gotta blow past. I got I've had roaches jump out of nowhere on me and just, everything just. I had a guy cleaning his kitty litter up. He pulled that kitty litter up, man. It's just, they went all over the place. I'm standing there around all these things running around me, but I don't play that game with them. I just don't entertain it. I just kind of been there for business, and that's it. Let's get to work. Screw that. Let's go. We got a job to do, and I want to get to it. So to be the pro in the home, you need to show the illustrations. You need to get to the point of the illustrations. You need to draw it out just like I show you. Mr. and Mrs. Jones, let me write down your names. You're Karen. And Karen, you're 35 years of age, right? Okay, you're James. And James, you're 40, right? Yes. You guys have any kids? This is important. Kids. Yes, we have 3. Okay. Do you guys, what is the mortgage payment monthly? It's $1,000. I only use $1,000 because it's an even number for me to do the math. Okay, neither one of you collect Social Security, obviously, but so you're aware, you have to be 60 years of age. So if God forbid something happens to him earlier, you can't collect his Social Security until you're age 60, just so you're aware of that. So that's income-wise. James, what will Karen lose if God forbid something happens to you on a monthly basis? How much money of income monthly will she lose if something happens to you? She'll lose about $4,000 a month. Now, Karen, what is your income monthly if James has no income? Mine's $2,000 a month. Okay, this is a puzzle that you're going to see a lot. So this here is another Index Universal Life program. You get them to overfund it, you teach them how to do. Now, James, does your company come with a retirement plan? Yeah, I got a 401k. How long have you been participating in it? I've been participating in it for about 10 years. I think it has about $60,000 in it, 30,000, whatever the number is. Karen, do you have a retirement plan? No, my company doesn't have it. I work part-time because of the 3 kids. Let me ask you guys another question. Do you have any life insurance on you? Yes, 1, 2, 3 policies. Find out what they are, how much the premium is. Find out how much they are, find out who they are, how much the premium is, and how much it pays out. Add all these numbers together and find out what you can do with this premium to get them this amount of money. Use all 3 premiums, put them in one big jar, and get them the face amount here. If this is term, Index Universal Life, final expense, beat that. Beat it and show them why. Right? So if this number, a lot of people will run into the fact that the face amount will be less than what they were getting before. Because you're able to come up with a number for them, but let's say this is a $100,000 payout due to the 3 policies he has and their final expense. The number is like $200 a month, and you get $200 a month. Now you should be able to blow that out of the water is what I meant. You should be able to get that $200,000 plus more money in their cash value. You got to talk about the cash value. You have to tell them about the cash value and the living benefits. So make sure you're talking about the cash value and the living benefits. Very important to talk about the cash value and the living benefits, guys. It really is. You want to tell them the interest. Show them an illustration. You know before you're in this house what you should do? Before you leave your office, what should you do if you know that this is a mortgage protection lien and it has a $200,000 home that needs to be paid?
Print out your illustration.
You do. You print out an illustration based upon an index universal life. That's correct. You base this upon getting the illustration done before you get into the house. One illustration for $200,000 on him. Second illustration, $100,000 on him. Third illustration, $25,000 on him. It's a lot of paper, but it works. You do one on her for $25,000 and maybe $50,000. Long story short, this is a lot of paper. I understand that. A lot of you don't get it, that this tangible piece of paper in their hand, this illustration that you bring to them, is this one here? These are apps done. If you bring that, put it in their hands, and it shows that this cash value or earnings, living benefits, and they're able to flip through it. They don't even know what the hell they're looking at, but it looks cool. It looks good. You know what I mean? It looks legit. If you show it on a screen from a computer, they can't believe that. It's on the internet. They don't know what the hell that is. And you can pop that up anywhere. You bring this illustration, invest into your paper, invest into your ink, and bring the damn illustration and show them this one here is it's $50 a month. This one here is $100. This one here is $200. You find out, Mr. and Mrs. Jones, Karen and James, at the end of the month, you guys have $5,000 to $1,000 left over after all your bills are paid. After every bill was paid, what do you have left over? Which are you closer to? We're closer to $1,000. So I'm going to show you guys how to put another investment away. Because, James, your market volatility is there due to your 401k may not be that large when you retire, due to the fact it's just volatile to the market. Karen doesn't have a retirement plan, so you probably put a small one on her and then a large one on you. But buy them time. Again, I'm going to erase this. It's going to be the last thing we do. Young people out there, we're covering that. So what you do is you show them the timeline. Karen, worst case scenario is we want to buy you 1 to 2 years to pay this house and sell it. This is the worst case scenario, okay? I know you want to stay here. Do you want to stay here, Karen? If he was dead, would you stay here? Yeah, maybe. I'm not sure. Okay, you take that $1,000 a month, multiply it by 12 months, equals $12,000 in a year they pay. You take that $12,000 in a year, you multiply it by 10 years. That equals $120,000 over the next 10 years, and you divide it by 2. That's the equity. Somewhat of the equity. It gives them a picture. Draw it up to $80,000 to $100,000 due to interest earned on the home. Take the 20-year mark. Bounce that up to $200,000. And, they could easily, it could look that way. So long story short, Karen, in 10 years, if something happens to him, we want you to be able to walk away with this $100,000 because, again, it's you against the bank. Here's the bank. Here's you. You don't have their money, Karen, and there's something wrong. You got 3 kids to cover. How much are your bills average, you guys, a month? You know? Yeah, we spend about $3,000 in bills. So a lot of that goes towards the kids and food and stuff like that, and the cars and the insurances. Sure. Okay. Well, Karen, you have $2,000 a month. You're short about $1,000. So we need to get you about at least $12,000. Here's what we can do. We can get you $25,000 or $100,000. Now, if he dies here, you should have enough money to pay this house off if you get the $200,000 or $100,000 policy. Now, due to his age, he's probably going to live to 80, but we never know. So during this time, if you guys make it to the end, all you're going to do is cash the policy in for the cash value. It'll be another retirement put aside for you. And I'm also going to show you guys that you can overfund this policy. You can stuff an extra $100 a month into it to earn on that 7% interest. That way you guys walk away at retirement. You could retire early. You could pay your house off early. You could take the cash inside here and you can pay the last 10 years of the home off. Okay, see how they got so many options that you guys are not presenting to them. But you don't want to confuse them, so you need to go back to it and illustrate it again. So let's review. What you have, Mr. and Mrs. Jones, is the ability to sell the house. You can pay the house off. You can pay the back end of the home off, back end, and then it comes with living benefits. So if God forbid you get into an accident, James, on the way, you get some head trauma, you get a cardiac arrest, a heart attack, stroke, end-stage renal failure, you get you can't dress, bathe, eat, toilet, transfer yourself around the house, that $100,000 goes while you're alive. So it doesn't mean that you just get it at death, guys. You can get this money while you're still alive, too. Your health insurance may not cover certain things. This will cover nursing home care, rehab. It covers a lot. If you're out of work, James, by the way, you're going to lose $100,000. You need to put this in place to protect your family. It should be, everybody that gets a mortgage should have to do this to protect it from the bank getting it and you losing the equity. Remember, the most important part of this puzzle is that we are protecting your wife from losing the equity in this house due to the bank getting this home. When they get it, they not only take your money, but they resell it for the appraisal price. So for what you have $1,000 left over a month, James. If I tell you, look, James, here's what you got to do. You have $1,000 a month left over, and all your bills are paid, right? On average. Let's say you have $500 a month. I'm going to take the two. You have a worst case scenario month. I take this $1,000. To pay for this policy, James, all your bills are paid. Can you live on $800 a month, play money? The answer is yes. James, over here, can you live on $300 a month and play money? Yes. So do we agree you can't afford it, right? Yes. Okay, well, that's what we're going to do. Let's do this $200,000 policy, and I'll show you guys how to overfund it. Or do you guys feel more comfortable with the $100,000 due to the fact that it's a little cheaper, but it pays out the back end? What this one does, it pays the house off in about 10 or 15 years. She'll have enough to pay the house off there, and it earns plenty of cash value that in the 20th year, you probably pay off the house there too if you cash it in. Now remember, it's living benefits too, guys. See how I'm repeating this stuff over and over again so they get it. I'm repeating it. I'm drawing it. I'm making sure it's embedded into them. If you want big number sales, make them feel comfortable with spending $200 a month. Does your car insurance cost you guys? It's about $2,000. I've seen it high, but let's do this. It's about $1,000 every 6 months. So that's in my mind. I'm saying, holy hell, you'll cover the car, but you won't cover your house. So you cover that car, and that car is what, 20-some thousand bucks. And this house is valued at $200,000. We really need to do this. We really got to do this. Let's take a look at this, and let's do the $200,000 one. When this policy comes, I want to go back over it with you. So I'd like to come back when the policy comes. Okay. So do we agree? Just wait. Shut up. So do we agree? Yes. Let's move forward. Write the policy. Have the policy out and assume the sale. Have the policy out. Start writing. Just say, James, what's your name? Your height, your weight? Assume the sale. Do not be afraid at that point. Pull the trigger. Okay? Get it done. You did your job. You explained it. If you need to continue to explain it, write the app up and continue to explain it. Oh, this thing's so great. You're going to have living benefits. You're going to have the cash value at the end. You're going to be able to pay off the house early. God forbid something happens to you. And it's not if it happens to you, it's when. You guys, you two, James and Karen, understand this is going to happen. It's like, is it going to happen tomorrow, 10 years, 30 years, 40, 50? So that's the part we don't know, but it will happen. James, I have insurance through my work. Sometimes they throw that at you. But that's okay, James. When you leave that job, that insurance doesn't come with you anymore. Yeah, but I have $100,000 in coverage through work, Yeah, but if you were to get hurt or injured tomorrow, that's off the table. They're not going to just pay somebody a $100,000 life insurance policy that doesn't work for the company anymore or can't produce. So you need to do this so when you retire, you have this in place. Now, if you guys don't like the big numbers, we can always do smaller numbers. Remember, $50,000 will cover her and buy her time. It's only, $37 a month or $40 a month. So if you feel uncomfortable with the numbers, I'm not here to take any food off the table. let me do this. Let's do the smaller of the two then, okay? But how about this? Why don't we meet in the middle? Let's do the $100,000 policy. Karen, do you feel like you need 100 or 50? Where do you kind of fit in? This is where I might use one against each other. Yeah, I definitely, honey, feel more comfortable with 100. Yeah, see, Karen understands this. James, let's get you to understand it too. That $100,000, what that'll do, so God forbid something happens to you in life, you get the money while you're alive. Second, every dime you're putting into here, James, doesn't go up in the ether. It is cashed into your savings account, earning interest. Higher, 9 times out of 10, in your 401k. So when you retire, you have that. So one way or the other, you two are either going to share in the money together, or Karen gets the money to pay the house off. You understand now, James? Yes, I get it. I have to explain sometimes in depth over and over and over again. So you guys need to learn how to do the same. All right, I've gone deep, man. Is there any other question? And thank you all for spending this time with me. I just know that it's important time that we spend, and it's going to work, man. We just got to get you out there practicing it. I'm working on a way to record myself inside the house. It's just that there's so many, it's just like there's so much personal stuff there, you know what I mean? I can't really find a way unless I get somebody. Or I can act it out with somebody if somebody wants to play a role. If there's anybody that ever wants to play a role with me on camera, let me know. So look, at the end of the day, we have everything you need. You got your lead systems. You got your, you have your, any other questions? Any other questions, guys? Say what?
I have a question.
Yeah, speak up. So everybody, I want everybody to hear you, buddy.
All right, on Thursday, you said you did 11 appointments, is that right?
Thursday, I can't do 11 appointments in one day, no.
I thought you said you had 11 six. I heard you talking
During the week, yeah.
Okay, all right. Okay, that answers my question.
Yes, during the week. I was 16. And Alyssa set that live. She set all those appointments live on camera last week, too. So that's actually recorded. Well, look, the reason I do that is not to sit with 16 people. It's to guarantee me the largest number at the end of the week. Look, I'm not going to sit with 16 people. That's not my goal. My goal is to find the numbers that I'm looking for, the annuities, the big number sales, and I'm going to run into some small stuff too. But my job is to create that need again, create create the sale in a way to where it sells big numbers. However, they understand it works for their future, why it's so important, and it will work for their family. Eventually, they're going to run into this money. How they run into it is multiple reasons. They could run into it to death, living benefits, cash value interest, potentially another retirement plan. So you guys need to explain that to them. You know what I mean? You got to make sure that they understand that. Anybody else have questions? I think a lot of people may have trouble with the pivot point too, right? When to close the deal at the end. And you got to assume that sale, man. So once you get to the end and you've explained it so much, there's a piece of you that will know when to pull the trigger and say, you know, something like, so we're all agreeing on this. This looks good. This is what you'd like to do. This is the one you want. This is the one that works best. Something like that. Just work with what you got and develop it. God has blessed each and every one of you to be here. You're in the life insurance game for a reason. You didn't just wake up one day and say, hey, I want to be a life insurance rep. None of us have done that. Okay? But we knew the game came with some big money. And I have been through the dirt of this thing all the way up to the upper echelons of this thing, and I'm still growing. And I want to take you guys with me. So just ride my coattail. Ask me the questions necessary. I remember being in classes, I raised my hand up and say, And another important thing we need to do is go over apps. How to write an app, how to write an annuity is very important. So we got to get that, and how to do the illustrations. Next week, I'd like to do one that shows you how to do the illustrations, and that might be neat to do. The long story short is that every time you see me erase this board, it meant that I was going through another sheet of paper. And that's literally what I do inside the home. I write. This is huge. This is just from this week. I write. It's just amazing how much I write. But it's necessary to draw out the numbers. So I'm running into annuities and shit and index universal lives, and then I'm going against their other products. I gotta be able to paint the picture for them on paper, show them why, what, when, how, what, it's all over the place, but then it's organized to show this end result, and they get it. I'm there to educate that client. You don't always win. We're not in a game of winning constantly in every single home, but we do win. And the most important part of the puzzle is you winning big, which means being able to get this stuff to a point where you can duplicate it. What am I doing right now? I'm duplicating my system. When one of you or two of you or three of you get it, and you start pouring in $3,000, $4,000, $10,000 a week, well, I get rewarded, but so do you. On a big level, man. I would rather take 100% contract level all day long and make $10,000 a week than take 130% and make nothing. You know what I mean? So don't be all about the contract levels all the time. Earn your stripes. Quit following a bunch of kids that don't understand the business, don't sell big, don't follow these guys. These guys are good at selling maybe for what they do themselves, for themselves, but they can't teach you how to duplicate it. And that's what I'm trying to do here. But remember this, I'm human. Without the questions you guys throw at me, I can't understand what you may be running into. So the next step of this puzzle is you all getting into the homes. So when we come back here, that you have the questions I need. I know none of you are in the homes because you don't have any questions. I'm not saying all of you. Some people on Facebook and some are in the homes, but if you're not getting bigger numbers out of people, why do you think that? Why do you think I'm able to, if I'm in the same house as you, I'm able to pull $100 premium and you're getting $30, or I get $300 and you're getting $100? It's all about bringing value. When you buy something, you want there to be value, and you're just not painting the whole picture in value, which means the product, So I just want you guys to bring value. I'm not judging you. I just want you to do the best you can for yourselves and make the most. You might as well make the most while you're in there, but at the same time, you're probably doing a better job of helping the individual too. If the larger premium's there, somebody's getting paid more money. So that's good, all right? Because with inflation in this world, tax increases, they're going to need it anyway. So do you ever talk about inflation in a home? Do you tell Mrs. Jones that inflation is 4%, 4%, 4% every year? It's 40% more in 10 years, Mrs. Jones. We got tax increases. We got a level income. So you got this level income, you got to handle all this. Mr. Jones dies, and you don't think you need it? Come on. Get the $25,000 one. It's $50 a month. That leaves you. Always show people what it leaves them at the end of the month. I think if I could teach you anything, it would be show them after this fits in their bill what they're left with a month. You have $1,000 a month left, so you have $950 a month left over after you invest into this. And this is earning you interest. And it comes with 25 grand tomorrow if it happens. Okay? This doesn't mean 25 years from now. That's the best scenario. The worst case scenario guy I am always knows to cover the person for tomorrow too. So you have $950 a month left over. You still got plenty of play money after you invest into this, okay? So what I'm going to do is I'm going to write this up and I'm going to come back and I'm going to deliver it to you, or we'll go over it together, okay? I tell them what I'm doing. I'm going to write this up, and we're going to go over it when I come back, okay? Thanks. Let's write this up. If you guys get ballsy enough, you'll be able to just do that. Tell them. Just say, I'm writing this up for this $25,000. And, we'll go over it when I come back, but I'm glad you understand it. It feels good to me to know that you understand this now, and now you're covered and you won't lose the home and you'll have all these benefits to yourself. So that works good. Faith, any more questions, buddy? Let's get you to fit. How about $20,000 next month? I'm taking Faith out. I'm taking a few of you out. So what I'd also like to do is I'd like to do some kind of weekend where we maybe spend a weekend in a hotel room. You guys can drive up, or I could do it in my own home. I've done it in my own home, to where we are in front of these whiteboards, multiples of them, and we draw all this out, and we make sure that people understand it. We're doing it live, and it works real well that way. So anybody have any more questions?
Yep.
All right.
Mortgage reception. A guy I used to work with.
Mm-hmm.
His home was $80,000. He financed $71,000. Would you do that mortgage protection for the whole thing if the wife decides she wants to stay there? But she doesn't work.
How old are they?
He's 38, she's 35.
I would show them the timeline, one, paying the house off, and then part two, I would show them a later years. At the 10th year, this is what you owe. How did you do that? You take the math, remember the math from the monthly mortgage. So again, if it's $1,000, you multiply it by 12, you times that by 10, you divide it by 2. That's basically what the equity is. I want her to be able to understand, if his income's gone, does she have enough to stay there anyway? So you got to do the math. You need to know, if his income is gone, does she have enough to stay in the house anyway? So that immediately tells me whether she has to sell or not. They're young, so without his income, the first question, one of the questions you need to get out is, can you stay in this home due to the fact that his income is no longer here? Okay? You got to get that.
That's when he's diabetic.
That won't matter in most cases. You'll be okay. That's it. You'll be all right with the IUL. Now, sometimes it's background checks are heavy on these.